afternoon and welcome to BizTech's Asian Midday Market Watch. It is the 20th of November and our regular Monday guest is here with us, Vishnu Varathan, Head of Economics and Strategy from Mizuho Bank, coming to us out of Singapore. Vishnu, as always, great to have you on the show.
Always my pleasure to be here, Brian. Thanks for having me this week.
Now, Vishnu, for a start, it's the start of the week. China has just left its benchmark, lending rates unchanged. What should we be watching out throughout the week that could move markets?
That's a good question, Brian, because there are, for those who are so inclined, there's the glass half full from China. Industrial production, retail sales were bumped up slightly more than expected. And then, for those miserable sorts like me, you've got the negative aspects of the data, which are the property market remains in a deep, deep slump. So investments in property and overall fixed asset investments on a year-to-date basis declined further, which means there was an acceleration of a downturn in these two parts. Our big picture for China is that the confidence is not quite returning. So yes, travel may be returning, including domestic travel. People are not spending as much, and even when they spend, they are opting for small ticket gratification, not big ticket durable goods and things like that. So that shows a confidence deficit. And if you marry that up with the deflation data, which is really odd, China is the only country that's got deflation, whereas everyone else is worried about inflation not coming down soon enough. But I think that's emblematic, putting aside any aspersions cast on the data quality, that's actually emblematic of the confidence deficit. And it really flows on from the property sector and then, things like high youth unemployment, so on and so forth. You put all of those together, that's what it is. So what are our expectations about it? Even if China's growth on arithmetics can make it above 5% this year, we should still be worried about underlying growth being well below. So 4 to 4.5% seems to be a reasonable case for underlying growth. Beijing will remain on its toes, will continue with a raft of measures to stimulate the economy, but they will always, I think, be a little bit short of what markets need to really get animal spirits out there. So we should anticipate that there will be bouts of cheer about China, but then there will be a reality check that comes in. How do we extend this to ourselves? It means we need to be in the rest of Asia mindful of the fact that China's spillover from stimulus will be very limited. A lot of it will be onshore concentrated to boost confidences, A. B, any consequent wobbles in the renminbi due to a lack of confidence would rub off onto our currencies as well. So whilst we remain very fixated on the so-called peak Fed, which was the other theme of last week, peak Fed, weaker dollar, pushing this too far too soon can have ramifications because any bouts of China weakness will probably see Asian currencies also buckling a little bit. And so it'll become harder to call a straight line dollar trend that's easy to trade. So those would be our concerns, not just into the end of the year, but perhaps going into the early part of next year as well.
Now, Vishnu, the other concerns around the region, obviously, are the differentials in interest rates between the US and, say, for example, the likes of Malaysia and Indonesia. We've got some insights into, perhaps we can get some insights from you in terms of what we should be watching out for in these two markets in particular this week.
Sure. That's a really good point you raised, Brian. And in fact, there are two aspects to it. And no pun intended, but we need to keep it real. And the rate differentials need to be seen from a real perspective, which means if the Fed were to hike nominal rates, so if nominal, whatever we see on the screen, type of interest rates in the US, whether it's very short end rates or yields go higher, that would impact adversely emerging Asian currencies insofar that rates don't keep up here. So that's the first part. The second part is insofar that inflation in the US comes down faster, that will also provide an advantage for the dollar because the lower the inflation, the higher your real rates are. And our current scenario is such that with any inflationary risks, being really concentrated in food and fuel, the likelihood is that the US might see softer inflation sooner than the rest of Asia, at least on the relative moves, and that would keep the dollar strong. One factor that's underappreciated about why the US can cushion itself from some of the inflation shocks is that in Q4 they are on track to deliver record oil production. Crude production is going to be about 13.2 million barrels per day, which means they are fairly insulated from the vagaries of the global oil markets. And this is something that the US would have as an advantage, not just over Asia, but over Europe as well. So insofar that there are stickiness around energy price or any upside shocks, Euro will underperform the US, and that will set the tone for the rest of Asian currencies as well. As long as the Euro doesn't outperform the dollar, it'll be hard for Asian currencies to rise on a sustained manner against the US dollar.
Now, Vishnu, what are the key things we should be watching out from an events and data perspectives for the rest of the week that could potentially impact markets?
There are, this week is going to roll by minute. I meant that in more than one way. We've got FOMC minutes, the ECB comes out with its minutes, the RBA comes out with their minutes. And this is the interesting part for us because I think the ECB minutes might, sound sexy, alluding to things like keeping an eye on inflation, so on and so forth. And so there may be a temptation to sell off the dollar because November FOMC minutes would be open to a dovish interpretation because the Fed would have been very careful when they crafted their statement and whatever they said during November. And here's the context. Meeting was on 1st November, and since the last meeting in September, US Treasury yields went completely bonkers. They went up by more than 50 basis points towards 5% for the 10-year. And so it was in that context that many of the FOMC speakers might have said, hey, hang on, we need to show more restraint, maybe no more hikes. But it was in the context of higher yields, whereas yields have come down sharply, even more sharply now, which means whatever they said then doesn't fully hold. So markets may oversell the dollar based on those minutes. And so those minutes need to add up. And this is what we need to keep a lookout for. If the dollar is oversold, it's going to snap back. And so volatility is very much in the game. Bank Indonesia meets this week. They're going to take the opportunity of a softer dollar to stay on hold. For now, in fact, they might even translate into a fairly resilient rupiah, but we're not done yet. The Fed is not done yet. And I think most of all in December, you need to see their communique, even if they don't do anything, and the revised dot plot. I think those will remain very important for us. So, in Oprah parlance, the fat lady hasn't sung. And so the dollar cannot be sunk, not quite yet, not decisively.
Now, on that note, Vishnu, thank you very much for your insights. Thanks for coming on the show.
My pleasure. Thanks, Brian.
Now, we've been speaking to Vishnu Varathan, Head of Economics and Strategy from Mizuho Bank. And this has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out the show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.